Good morning, everyone. My name is Tiago, as a lot of you already know. I'm here together with Nikolay, and thank you for coming to our second webinar from SPI, Wall Street Talks brand. Just as a highlight, after the first webinar where we focus on the index report we did together with the index standard, today, as we're coming to the end of the year, we wanted to give you an overview of 2020, the US structured product market, as well as to give you an estimate what we think is going to happen in 2021. So, with no further ado, I'm going to give Nikolay the word.
Good morning, everyone. My name is Nikolov. I'm a structured products analyst at SPI. Today, I'm going to present you the first part of our US structured product market overview. I'm going to start with market volume, issuers, payoffs, and underlyings. Then I'll hand it over back to Tiago, who will be sharing quite interesting insight on the latest trends and opportunities. Just a brief note before I'm getting into the topic. So SPI currently covers an estimated 60% of the US structured products market. That included registered, unregistered notes, and market-linked CDs. This year, SPI's coverage has improved to fully cover registered notes, as you can see in the footnote at the bottom. So I believe I can really start now. Both charts you can see account for the positive market growth throughout 2020, with about 30% more in deal volume than that in the same period last year. The first quarter was particularly successful, as it largely benefited from still good rollover speed of expiring products in the beginning of the year. Then a positive factor since has been the increased volatility from March, which we know is important for building structured products. It might be worth mentioning that even though the quarter-on-quarter growth has been positive throughout 2020, the month-on-month growth has fluctuated. We particularly note a sharp monthly drop in sales in April and May, which has still been partially caught twice in the subsequent months in June and again in September. In October and November, issuance remained flat and 6% lower than in September, but nevertheless slightly above the volumes in October and November 2019. Basically, it accounted for some 9% year-on-year growth. To conclude the slide, we see some slowdown from the year-to-date growth in previous months, which is to say that structured products drew more investment earlier in 2020 than they did over the last months. Now let's see what's changed on the issuers landscape. Barclays is about to finish the year as the top issuer with a 13% market share. Although issuing less in the later months than in the first two quarters, it's still been a 22% year-on-year growth for Barclays, which issued nominal of $9.3 billion year-to-date. On the flip side, JP Morgan have lost ground this year, as they fell from the first place last year to the fifth place as in the beginning of December. JP Morgan are also the only issuer whose sales didn't grow year-on-year. Citigroup have achieved the highest year-on-year growth year-to-date. This has been an impressive 83% sales on the back of $7.7 billion as in the beginning of December. Second and third more active issuers over that year have been Goldman Sachs and Morgan Stanley, who sold $8.1 and $7.9 billion respectively. Here's our update on the principal payoffs. Starting by the graph on the left, our first observation is that market continued favoring products that expose capital at risk. Only about $1.4 billion worth of products sold in 2020 offered capital protection, which is about 2% of the overall sales volumes, and less than in 2019. On the other hand, nearly 60% of the sales volume raised this year came from products that featured downside protection in the form of a knock-in barrier. The typical protection barrier is set at 70% and is followed by the 60% barrier. That means that if invested capital is protected at maturity, so long as the underlying does not depreciate below these levels. So now be careful from 2019. Now, what I think is more interesting is that this year market growth has largely been realized on the back of income products. Indeed, the interest towards income structure has confirmed itself as sales have increased by nearly 90% year on year, which made it the dominant category in 2020. Another observation, in the pie chart, auto-callable structure gained additional 6% market share at the cost of products without that feature. Just to mention that auto-callables combined with soft protection stood for over a third of the sales in 2020. Now the table, let's have a look at it. With the table lists the most used payoff types. Just briefly mention that the top 10 payoffs accounted for more than 3/4 of the sales volumes raised year to date. Slightly under half of it is coming from auto-callables. The single most popular type of most popular payoff remains the barrier Phoenix structure, which accounts for approximately 41% of the volumes traded in 2020 so far. Defensive Phoenix structure of this type have been successful this year, as many of them have managed to pay high coupons, even with limited fall in the underlying, when downside barriers were not breached. Participation structures taken as a whole in all their subgroups represent around a third of the volumes in 2020. Capped upside products only account for 20%. Among them, most popular is the regular capped participation structure, which accounts for 8% of the total volume, slightly down from a 10% market share in 2019. Capped participation products with a buffer lost a combined 6.5% market share for the previous year, and these were also the only structures in the top 10 that experienced negative year-on-year sales growth, specifically down 7% and down 11% in the case of the capped buffered participation structure that apply a geared downside participation. On the positive side, barrier reverse convertibles without autocall features, so the biggest year-to-year sales growth, coming to $1.3 billion year to date, which is almost as much as the autocallable version of the structure, which also increased over the year. Now, single underlying products accounted for 58% of the sales volume year to date. This means that they remain more popular than multi-underlying deals. However, in terms of year-on-year sales growth, worst of option structure outpaced single underlyings, as they were up 88% compared to only 34% for the single underlying deals. Additionally, worst of option gained 9% market share in 2020, while baskets and single underlyings gave up 5% and 4% from their market shares, respectively. In terms of multi-asset linked products, worst of option structures again remain more popular than baskets, with a large margin, about 30% of a basket deals. Basket linked products have also recorded a 28% decrease year on year. The S&P 500 has remained the most popular single underlying, with around 25% market share over the year. The S&P is also a popular choice in multi-underlying deals, as it appears in the top 5 combination used this year. The combination that experienced the most growth in 2020, compared with last year, was the combination of Dow Jones Industrial, the Russell 2000, and the S&P. And it has been followed by the Nasdaq, the Russell 2000, and again the S&P. So here I'd like to pass it on to Tiago for the next slide. Tiago, over to you.
Perfect. Okay. Thank you, Nikolay. Again, I've enabled the Q&A mode, so if you have any questions during the slides, please feel free to put them on the Q&A mode, that me and Nikolay will take them as we can. Okay. Now, to finish the 2020 numbers, of course, we couldn't miss the distributors. Again, what we put it there was a pie chart with the top distributors. Again, this is our current estimate, and no news on that side. UBS, Morgan Stanley, and Bank of America leads the top 3 table. But I think what is more important than the league table is the numbers on the left. And why do I say that? Again, I think besides the market share, it's very important to understand some key characteristics of the US market. And I think there are 2 main conclusions from those numbers. It's one, we wanted to analyze from the big wirehouses how actually they are open to sell other issuers' notes. Okay, and we actually find out some interesting numbers. So looking to the average of the big wirehouses, we see that 73% of their sales are in issuers then not from the same group, while they sell 27% in average of their own notes. And although this number, you can see there was a small shift from previous year towards a bit more of the same issuers as you expect with higher volatility, is that this percentage is almost 74%, is the biggest open architecture percentage in the world. Much bigger than in Germany, France, on the big private banks. And I think that that's something which is quite important to highlight, that there is big open architecture from the buy side to get the best prices for the clients. And then third, because of all the changes that have been happening, we wanted to analyze the competitiveness of the US market. So we used a monopoly methodology called Erfindel-Ishman Index, or HHI score, which measures competition and concentration, in this particular case, of the US market by issuer. And although 16% doesn't mean much, what a lot of the regulators and a lot of people using this type of indices to measure competitiveness is, of course, the change from previous year. And what we saw, that went from 12% in 2019 to 16% in 2020, which means that there was more concentration on the top issuers against the smaller issuers. Personally, I believe this has to do with issuers being less competitive due to the higher volatility in the beginning of the year, which allowed the more efficient manufacturers like Barclays, Goldman Sachs, Citi, and JP Morgan to keep their market share. Right. Now, a lot of you also know that besides market intelligence, we also offer reference data and life cycle, which makes us be able to use and analyze much better the structured products market. So what we did here, we wanted to make an analysis on the performances, on the live performances of the products since the beginning of September. And we found actually quite interesting aspects. One is that we compared against S&P 500 performance, as well as the US Treasury bonds. We used an ETF, as you can see by the orange line, and the S&P 500 as the gray line. What we found out is, since the elections, actually income products in the US market, and again, that blue line represents the average daily performance of structured products, income products, weighted by the amount which was sold on these products, but which is outstanding, is that since the elections, income products and growth products actually are delivering much more than the S&P 500. And one of the reasons, of course, was that a lot of the products were struck back in beginning of second quarter and the first quarter of 2020, which allows the products to be now well in the money. And second, we also noticed that even the capital protected products, which has a good representation of the market link CDs, are currently outperforming the US Treasuries. Of course, why? Because clients locked a higher interest rate environment than what we have today. And second is because they are linked to equity markets mostly, they are definitely outperforming fixed income. Now, what does that mean for the future? So we've put together here an exposure of the current US portfolio in structured products. You'll be able to see here on the left the current level of the all the structured products live in the US against the strike levels, and on the right you'll be able to see the market exposure of these indices. And I think there are a couple of conclusions which are quite important to highlight from this. Is that 50% of all structured products, of all volume currently outstanding on structured products, are at 110% or more above their strike level. So they are well in the money and providing return to the clients. On the negative side, there is currently 3% of the products that are potentially providing a negative performance. But again, if you think about it, it means that 97% of all structured products which are currently live are protecting the capital or giving a positive performance to the investors, which is quite positive. And what you'll see there on the right is, of course, that almost 1/3 of this exposure is linked solely to the S&P 500, followed 6% by the Euro Stoxx 50, and then followed by the worst performance between equity indices like the Russell 2000, S&P, the Euro Stoxx 50, and of course the Nasdaq 100. And Nikolay also put together here a list of the best underlyings, okay, as well as the worst performance at the moment. And what we'll see is that tech firms, tech stocks have clearly the ones outperforming mostly. You can see here the average current performance of structured products linked to Tesla, to Nvidia, the FANG index, and so on, which is not a surprise. And also as not a surprise, of course, on the negative side, is mostly structured products which are linked to oil and gas exploration or banks. So you can see there that those products are currently 50% down of their strike level. So with their barrier level being at 60%. So clients to be able to recover their capital, the oil and gas sectors needs to increase an extra 20% during the next months. Okay. Now, looking at these and looking at that exposure, of course, we need to think about 2021. And I think there is one key factor that will make 2021 a success, which is the rollover speed. So we created this index, which tells you the percentage of structured products coming back to the market, expiring or maturing earlier. And what we found out is that in the beginning of the year, with the bear market, you saw that rollover speed decreased very rapidly to April to less than 0.5%. Since then, we saw a massive increase going back to previous numbers from 2019. And that means that equity speed is clearly increasing and allow the structured products market to grow. And to finish, this is what we wanted to tell you in terms of forecast for 2021. The truth is, as Nikolay mentioned in the beginning, is that there was a big push for income products with lower interest rate environment and with higher volatility. It was the perfect time to sell volatility and get income. And that is also going to impact positively 2021. With a lot of these products being in the money, a lot of these products are also going to mature earlier. Okay, our current estimate, is that there's going to be $71 billion coming back in the market in 2021, with 38 billion being of maturities, product coming to the maturities, and an extra $34 billion of potential auto calls at the current levels. Okay, so our estimate is that the 71 billion plus an extra 3 billion dollars of coupons and interest will come back to the market. And we also estimate that because of the success of these products and their performance, structured products market will get an extra $6 billion of new money. And again, that 6 billion, it's between the average of the last 10 years every year. Now, you might think, of course, what happens if there is a bear market beginning of the next year? In that case, if the S&P 500 decreases, let's say 15% by beginning of January, this 81 billion will decrease to 74 billion. Okay, but if it increases an extra 10%, this 81 billion will only increase to 84 billion. So that gives us an idea that this 81 billion is a good estimate, but as long as there is not a bear market. So with that, and I guess with 13% growth estimate for 2021, we'd love to answer a few questions if someone has. We'll give you a couple of more minutes, and again, you have the Q&A chat there, so you can always write to us. Okay, not sure if we will have questions. Look, while we wait, look, thank you everyone to attending this webinar. We'll make the presentation available to the people who participated, and we are also going to post this webinar on YouTube, so we'll make available for everyone. But again, if you're curious to know more about the market, the data that we have and that we are analyzing in the US as well now in Europe, please feel free to contact us, me, Nikolay, or anyone else within the Wall Street Talks team. Okay. So no questions. So look, thank you, Nikolay, for participating, and thank you, everyone.
Thank you, everyone. Have a good day.